Has the Fed ruined everything for you?
Vonnie, now that you mention it, you picked the week to interview me last at the inflection point at the lows that week. And since we just had a rip to the upside, and it's been rather remarkable. And here you are, bring me back on when we've just set new highs. So not today, but yesterday, that is. So you're quite good with picking these inflection points. I have to hand it to you.
Well,
In terms, in terms of the Fed, yeah, I mean, the Fed, Jay Powell, convenes tomorrow, and what you saw over a 4-week period beginning in mid-March, running through mid-April, is the Fed added to their balance sheet $2 trillion. And so they've taken the balance sheet in total now, $3 trillion, from $4 trillion to $7 trillion. That's a lot of treasuries and mortgages and other assets to buy. But I think what comes out of tomorrow's meeting is they're going to slow down the pace to about $100 billion a month, coming down from $2 trillion in 1 month, because the markets have started to do their bidding. The markets have done their job by normalizing, and the liquidity they've added has really fixed all the liquidity in the system. Tomorrow we'll also get forward guidance, and rates will be zero for a very long time. Count on 2023 or longer. Of course, you've been talking about the yield curve and whether there's a fixing for the yield curve, but I think most of his comments will be around the fundamentals, in addition to kind of monetary policy. And the fundamentals is really all about jobs and GDP.
So we have a bunch of Fed programs that have been aiming to help companies and sort of maybe do your job for you in some ways. But the default rate now is something like 4.5%. And as you said, we're at the highs, in the most recent sort of cycle. What happens next? Do we get another leg lower? Do we get, more fallen angels? Do we get a whole bunch more distress?
Yeah, it's a really good point. I mean, when we spoke last, the high yield market was yielding 12%. Today it yields 6%. So it's come ripping back. You've had record buying for high yield bonds with $50 billion of inflows coming into what's recorded markets like mutual funds and ETFs and others. It's been record inflows. And so with that, the markets feel a lot better. But below that market and below the surface are these undercurrents that you're talking about. And so although the markets are somewhat healed now, Vonnie, the real economy's not, and a lot of these companies are not. And there's a lot of problems brewing. And so what do we expect with default rates? Well, we've recorded at Marathon since the beginning of COVID, since mid-March, we've recorded 60 bankruptcies here in the United States, totaling about 100 billion. And we think that 100 billion number will grow to 400 billion. That is, the 4.5% default rate will grow to 18% cumulative, which takes you to an annual default rate of about 10. So default rates, as you know, is measured in trailing 12 months. And so we'll go from 4.5% to 10, but before this is all over, there'll be a cumulative rate, which is 4 times the 4.5% that we've already seen, 18%, taking you to 400 billion. As it relates to, downgrades, the downgrades are coming, they're coming ferociously. We have 20 downgrades. It's actually close to 30 downgrades for every upgrade by Moody's and S&P's, the credit rating agencies. And so that 20-30 to 1 ratio is so much greater than we saw in the great financial crisis, when the ratio was more like 10 to 1. In terms of fallen angels, you mentioned that. There's been about 200 billion, not quite, about 185 billion thus far. Investment grade that's fallen to high yield, we think that number grows to 400 billion as this plays out over the next year and a half, because what's really ailing these companies are revenues and EBITDA, despite the Fed injecting all this liquidity and market rushing into both the equity markets and the credit markets. And markets should improve because that liquidity gap has been healed in a very big way. I mean, the US is a $21 trillion GDP, and the Fed has added $3 trillion to its balance sheet, and in fiscal spend, that's also been about $3 trillion. So it's $6 trillion on a $21 trillion GDP. If you think about it that way, that's 28%.
Just on the bankruptcies for a second, Bruce, that $400 billion, will that be the liabilities on the balance sheets, or what will that $400 billion be? Because sometimes it's hard to actually tell.
Total debt outstanding of these companies that file for bankruptcy in aggregate, we think it's to 400 billion. It's currently 100 billion. So we think it's a fourfold increase from here. Yes.
And then I have to ask about Hertz, because it's been performing so strangely the last few days. I mean, you would have thought that the equity tier would be wiped out, and yet we saw this huge rally. What's going on, Bruce? Should we see that in other companies too?
Well, I think Hertz is quite unique, being a car fleet rental company. And what triggered Hertz falling, really, when you peel back the onion, was the margin call on the fleet finance. And so they have all this fleet. They have $11 billion in autos. That's the market value, 500,000 cars in their fleet, and they finance a bunch of those cars. And they had a margin call on that in some of their financing packages, and they couldn't make that margin call. And that's what followed the bankruptcy. And what you saw in the month of March and for the first part of April is you couldn't sell a used car because the market was just completely locked down. Used cars right now, and they've sold 50,000 at Hertz, 50,000 cars in recent couple of weeks, and they're selling it above their NAV, above their mark value.
Okay.
Because used cars are flying off the lots because, number one, the OEMs aren't producing them, and number two, I think as people start to move to the suburbs or start to think about moving away from mass transit as it relates to responding to COVID, there's been a huge bid now for used cars. And
Yes.
Hertz is capitalizing off that. So they're in a much bigger position. So what they'll do is they'll shrink their fleet from 500,000 cars to something like maybe 200,000 cars, maybe even less. And they'll make money in the process from current value. And that's why you're seeing the equity respond the way it is.
So Bruce, talk to us a little bit about what you're buying, because I know last time we spoke to you, you had a lot of different thoughts on the hotel industry, for example, on the gaming industry, and obviously you've been big into real estate, multifamily, and more so commercial. What are your thoughts on how that's all progressing?
Well, the real estate markets are really, really fascinating. And, you look at all these various markets, start with hotels. The revenues for hotels have declined the most of any asset category in real estate. And so those revenues are down, when you look at RevPARs, down 90, 95%, and from peak to trough. I think hotels, obviously you need a vaccine first, you need people to start traveling again, but I think hotels come all the way back. And so there's nothing broken with hotels, but there is something very broken with retail. Number one, the malls, and number two, too much square footage relative to our population and what our spend is. And so we have about 6 times the amount of retail square footage here in the United States that we sell product out of in terms of boxes and retail than we do in Europe. And so we're so much over retailed. And as we move to online distribution and just-in-time distribution, we just need a lower footprint. So while hotels, I think, have gotten absolutely decimated and have to make it through this period of time of social distancing, I think it comes all the way back where retail just needs to be a lot smaller and a lot smaller and a lot smaller yet. You look at office and it's very different. Office is actually held in quite well in terms of its incomes and what's been paid in terms of its rent rolls. But the work from home, kind of the inverse of Zoom, is working at office. And when you listen to Twitter, when you listen to Facebook, when you listen to a lot of these companies that are moving employees to a work at home environment or a suburban office, that may have a big impact, I think, in the intermediate term in downtown office. And then finally, multifamily, while it should be doing well because people need a place to live, I think there's a big migration away from cities that are just now happening as millennials start to embrace the suburbs. And what you'll see is home builders do well and suburban markets do well relative to city centers based upon what's just happened. And no place is more evident than the discounts that you can get now on New York City multifamily, especially at the intermediate and high end.
But given your arguments,
Bruce, 2 and
Bruce,
3 months and dropping rents 10, 15%.
Yeah, are you interested in that though, given your arguments, or would you still be staying away?
Well, I think you have to be very, targeted in what you're going to finance or what packages you're going to provide bridge finance for. And we're very active, as you know, in Europe, buying non-performing loans and buying loans secured by real estate to get to underlying properties. And we've had a very successful track record in doing that in the past. And we're going to continue to do that in the years to come because we've just restocked that inventory of workout real estate opportunities by a whoppingly large amount.
So we were just talking there about the dry powder that you had to put to work. And of course, there's a little bit more competition now as well with the amount of distressed funds that are being raised at the moment.
Right, that's a really good point. And we count the number at about 100 billion that will have been raised this calendar year that can capitalize off the distressed opportunities. Again, I referred to a number earlier of 400 billion in distressed. Only what's 100 billion has come. So there's a lot more opportunity set, I think, than what the capital is available as this plays out over the next year and a half, as a lot of these problem situations start to get worked through. And, you take a look at the airlines, for instance, and at the peak, TSA was running about 2 million through their checkpoints on a daily basis here in the United States, 2 million on a daily basis. The nexus of that was like 2.2 million. It troughed at about 90,000, less than 100,000. It's recovered rather substantially, a fourfold recovery, 400% increase, but it's only up to 400,000, right? So the fleets, take, American, United, Delta, they're going to only run 50% of their fleets, and those 50% of their airlines, they're going to be running at 50% capacity. So it's about 25%, and they need to get to 65, 70% to break even. So one of two things have to happen. They either have to do a Hertz in terms of wanting to downsize its fleets, or we have to get a lot more activity going because they're continuing to burn cash. And yes, they've taken $25 billion of cash from the government money that's been made available to the airlines, but it won't be enough if this extends for a longer period of time. So the real key question is then going to be the second wave and the impact on certain industry sectors. And take airlines for a second, and Marathon is actively looking to finance leads, do sale leasebacks with the airlines. And we've done a bunch of that in the past, and we'll continue to do that in the future. And we have a few proposals in front of us as we speak right now.
American
There's lots of opportunity across all the industries. I mean, I look at healthcare. We're financing lots of healthcare companies, and a lot of these companies are not troubled. They're just looking for growth equity, and they're looking for growth debt financing, in addition to companies that just need a bridge through problems they may have in the supply chain or with a hospital. And so there's lots of really good opportunities across the spectrum. It's not energy, it's not just retail, it's every industry group.
Are you avoiding energy, by the way, Bruce? Because I know that's an area that you've
completely avoiding energy.
Yeah. Mm-hmm.
Yes.
It's been an area that you've avoided in the past. So
exactly.
In terms of going forward, then you obviously are, you're in the loan market. I would love your thoughts on sort of the gaming industry, and also what happens when we get further out, now that we're opening up. New Jersey literally just now lifted its stay-at-home restriction. Do we see a change in sentiment around the country? Do we perhaps even see a change in leadership, and how would that impact markets?
Well, gaming specifically, Vegas just reopened on June 4th, and what we've seen is very positive. But again, it's a bounce off of a very low level. So if you look at MGM, Bellagio, some of these hotel companies, they've reopened with about a third of their hotels, and they've socially distanced their tables. And so while the numbers look good, the fact of the matter is they're very low numbers. About 50% of Vegas receipts come from air travel, and about 50% is a drive-to market locally in Nevada, as well as about 25-30% coming from California, since it's about a 3-hour drive. And so about 50% of the revenue is entertainment, whether it's Celine Dion or Taylor Swift performing, or food and beverage. They get a lot of revenue from entertainment and from food and beverage. It's not quite so conducive when you have COVID-19. So they've reopened, they've given away rooms, they've had incentives for free drinks, and they've got people in to socially distance with the gaming on the gaming floor. And so receipts per gaming location look okay, but it's only a small portion of the hotels that are open. What the hotel sector that looks better and gaming sector that looks better is some of the regional markets, like a Mississippi, or a Connecticut Indian gaming location that's really a drive-to market solely.
Yeah. Bruce, what about this environment? I mean, it's extremely fraught at the moment. It's troubled. It has been for a long time. At this point, though, we're headed towards an election. It's only a few months away. How are you thinking about how the environment is changing politically in this country, and what opportunities that might present?
Well, I mean, election is coming up November 3rd. Let's all get out and vote. Predicted is looking very, very favorably. Predicted being a bookmaker's site. and it has odds in favor of Biden winning. Not only a blue, victory in the White House at 1600 Pennsylvania Avenue, but also the Senate as well. And so a blue sweep is completely possible at this point in time. But again, it's still nearly 5 months away. I think number one is tax. I think corporate tax rates will go back up, not all the way back up to 35%, but close to 30%. And that will not be good for S&P 500 earnings, because the reciprocal, the reverse will happen. And remember, when corporate tax rate came all the way down from 35 to where it is today, that was about a 25% boost in corporate earnings. That immediate effect over that period of time, over that 1 year period of time. So we think the reverse can happen. Also, individual rates should go up, and the SALT will be repealed. That is if Biden wins. If Biden wins, there'll be big government spending and big deficits, but we have a pretty big deficit today. I mean, this calendar year is coming in according to budget office at about 3.7 trillion expected.